Most people out there are saying, crypto is just having a technical rebound. This is just a dead cat bounce. The bull cycle is already over. But if you've lived through enough financial cycles, long enough to understand how the US market really works, you'll know an uncomfortable truth. The market rarely tells the truth to the majority. The data tells a different story. Liquidity tells a different story. Capital flows tell a different story. When you put liquidity, ETF inflows, and Bitcoin's price structure into the same picture, you start to see something very familiar to those who've survived multiple cycles. Backhand index pointing right, Bitcoin usually starts rising before most investors believe a new cycle has begun. And in 2026, this story is repeating itself. Bitcoin is not an asset driven by emotion. Bitcoin is an asset driven by liquidity. In the global financial system, there is no asset that reacts to capital flows as quickly as Bitcoin. When liquidity is withdrawn, Bitcoin collapses first. But when liquidity returns, Bitcoin is always the fastest runner. And right now, we're seeing very familiar puzzle pieces fall into place. The possibility that the Fed will be forced to pivot policy. Political pressure making it difficult for the US economy to remain tight for much longer. And most importantly, ETFs have legitimized Bitcoin within the US financial system. Bitcoin is no longer standing outside the game. It has entered institutional capital flows. Many people ask me, what does AI predict Bitcoin will reach in 2026? But as someone who's worked in finance for many years, I don't use AI to believe in a specific number. I use AI to measure the market's expectation range. And what's noteworthy isn't $180,000, $220,000, or $300,000. What matters is this. Every model agrees that Bitcoin in 2026 will be significantly higher than it is today. That kind of consensus is rare in a market full of contradictions. And within that context, a very American trend is unfolding. Investors no longer want to self-custody private keys. They don't want legal risk, tax risk, or operational risk. They want crypto ETFs. Products that fit into IRAs and 401(k)s. Large capital flows, slow-moving, but extremely durable. And that's when names like BLOX start appearing on the radar of smart money. Not because it's flashy, not because it promises insane returns, but because it's designed for the cycle, not for a short-term trade. In this video, I won't talk about FOMO. I won't talk about calling tops or bottoms. We'll talk about structure, strategy, and how institutional capital is preparing for Bitcoin 2026, before most people even realize what's really happening. After understanding the big picture of the market, the next question is no longer, will Bitcoin go up or not? But rather, where will the capital flow when Bitcoin truly enters a new cycle? In the United States, investor behavior has changed very clearly over the past 2 years. Most medium to long-term investors no longer want to self-custody private keys, nor do they want to deal with legal risks or the complexities of taxation. They want products that are regulated, easy to manage, and compatible with the existing financial system. And that is exactly why crypto ETFs are becoming the primary gateway for large capital flows into Bitcoin. But not all ETFs are the same. BLOX was not created to chase the highest yields. It does not try to attract investors with eye-catching numbers like 60% or 70% annual yield. Instead, BLOX is designed in a very Wall Street way, prioritizing long-term structure, accepting moderate returns in exchange for sustainable growth. The core distinction of BLOX lies in the fact that it is an actively managed ETF. The fund doesn't just hold Bitcoin, it also combines exposure to Ethereum, mining companies, crypto-related businesses, and even technology and AI stocks such as Nvidia and TSMC. This approach ensures that BLOX is not dependent on a single variable. More importantly, BLOX's number one objective is not income, but capital appreciation. Income is a secondary factor. This is something many investors overlook when evaluating crypto income ETFs. BLOX's option strategy clearly reflects this philosophy. The fund does not apply a rigid strategy. When the market is sideways, it prioritizes generating cash flow. But when the market starts to trend upward, it reduces call selling to preserve upside potential. This flexibility helps BLOX avoid NAV decay, a common disease among many high-yield funds. And the numbers don't lie. Since the end of June 2025, BLOX has delivered a total return of approximately 24%, while spot Bitcoin exposure through the IBIT ETF has underperformed significantly. This occurred during a period when Bitcoin experienced sharp drawdowns and was even negative on a year-over-year basis. BLOX, by contrast, managed to keep its NAV positive. For a US investor, this is an extremely rare performance profile. Consistent income combined with outperformance versus simply holding spot Bitcoin. Of course, BLOX is not for everyone. If you are seeking extremely high short-term yields or care only about immediate income, funds like LFGY or YieldMax may be more suitable. The trade-off, however, is accepting NAV erosion over time. BLOX is for investors who believe that Bitcoin's cycle is not over and that 2026 could be the year when market structure changes entirely. Those who want both cash flow and the ability to grow capital when Bitcoin enters a strong expansion phase. When comparing BLOX with other crypto income ETFs, the picture becomes very clear. BLOX sits at the center between growth and income. It is not extreme, not flashy, but deliberately designed to survive and thrive through an entire cycle. From a strategic perspective for 2026, I believe that when Bitcoin truly enters its upward phase, the ETFs that can capture upside while preserving NAV will be the winners. Not the funds with the highest yields, but the funds with the best structure. Personally, I'm still holding LFGY, but I'm considering rotating part of my portfolio into BLOX. Not because of FOMO, but because I want to prepare in advance for a scenario where Bitcoin rises far more than most of the market expects. This is not a story about predicting tops or bottoms. This is a story about risk management and understanding capital flow structure. And in a market where the majority always reacts late, the greatest advantage is not knowing what will happen, but whether you are prepared for it. If you've ever observed how institutional capital operates, you'll notice something very interesting. They never wait until the narrative becomes obvious. When the media starts talking loudly about a new cycle, when social networks are flooded with optimism, most positions have already been built long before that. This is especially true with Bitcoin. In every previous cycle, Bitcoin has always made the majority of investors feel not quite convinced right before entering its most powerful phase. And 2026 is bringing back that familiar feeling. Not overly euphoric, not overly pessimistic, just a quiet sense of doubt, exactly the kind of environment that smart money tends to favor. In the US, experienced investors don't ask, "How high can Bitcoin go?" They ask a different question. If Bitcoin rises, what structure am I holding that allows me to benefit the most while still controlling risk? And that's where products like BLOX come into play. Instead of trying to maximize short-term yield, BLOX is designed to move with the trend, not against it. When the market is sideways or highly volatile, option income helps cushion the portfolio. When a clear trend begins to form, the fund doesn't mechanically cap upside. This is the difference between a strategy built for traders and one built for cycle investors. Another point that very few people pay attention to: diversification inside BLOX does not dilute the Bitcoin thesis, it actually increases the probability of success. Ethereum, mining companies, crypto exchanges, and even AI stocks all benefit in different ways as the crypto ecosystem expands. This creates a portfolio with multiple engines at the same time, rather than relying on a single driver. That's why during periods of Bitcoin weakness, BLOX doesn't collapse. And during Bitcoin recoveries, BLOX can climb much faster than many people expect. Compared with pure high-yield ETFs, the contrast becomes even clearer. Those funds perform very well when the market is flat or mildly declining, but when a true uptrend forms, they often become a constraint on the very investors holding them. High yield comes at the cost of selling away the future. BLOX does not. I often tell the investors I work with in the US, returns don't come from choosing the right asset, but from choosing the right structure for the environment. And the environment in 2026, if liquidity conditions and ETF flows are telling the truth, will be one where flexibility and the ability to preserve upside matter more than ever. Personally, I don't believe in going all in on any single scenario. I don't believe in forecasts carved in stone. But I do believe in preparing a portfolio for high-probability scenarios. And one of the highest probability scenarios right now is Bitcoin entering a stronger growth phase while the majority of investors are still hesitating. That's why I'm considering adjusting my portfolio structure. Not because I want to chase the market, but because I don't want to be stuck in structures that only worked in the past. In investing, the biggest mistake is not choosing the wrong asset. The biggest mistake is failing to change the structure when the environment has already changed. And if you're looking at Bitcoin in 2026 purely through the lens of price, you may be missing the most important part of the story: how capital flows are preparing right now. And when you step back to look at the entire picture, one thing becomes very clear. Bitcoin 2026 is not a story about fast trades, not a story about calling tops or catching bottoms, but a story about structure, patience, and being positioned correctly. Financial market history always repeats itself in remarkably similar ways. The periods when an asset is most heavily doubted are often precisely when the foundation for the next cycle is being built. Bitcoin is no exception. It doesn't need the consensus of the majority to survive, it only needs time. And smart money has always understood this. They don't ask, is Bitcoin dead? They ask, if Bitcoin isn't dead, where am I positioned in this cycle? Products like BLOX are not promises of quick wealth. They are not flashy, not loud, and they don't try to attract you with extreme numbers. But precisely because of that, they are designed to survive and grow through multiple phases of the market. In investing, the most important thing is not the highest return on paper. It's the return you can actually keep when the cycle changes. If you're looking at Bitcoin 2026 from a long-term perspective, if you care about how institutional capital is preparing right now, and if you want to understand the market rather than chase it, then discussions like this are where your time should be spent. Backhand index pointing down, now it's your turn. How are you preparing for Bitcoin 2026? Will you choose to hold spot, ETFs, or a combined structure? Leave a comment below. I always read and respond to thoughtful perspectives. If this video gave you a new way of looking at the market, hit like to support the channel. And subscribe if you want to continue following deep, slow, but structured financial analysis, the way smart money actually operates. In the next video, we'll go deeper into portfolio allocation strategies for the new crypto cycle, and how to avoid the mistakes that push 90% of investors out of the game. Thank you for your time. See you in the next video.